So in this video, I'm going to show you how to remove the taxation from your 401k, your IRA, your cash balance plan, SEP IRA, any pre-tax retirement account. I'm going to show you how to eliminate 100% of the taxes on the distribution. And on top of that, not have to worry about the 4% rule because this structure right here is going to generate a safe fixed 10% dividend. And without further ado, let's get into how that works. So my name is Jeff Hanna. I run a financial consulting firm. I help people reduce their taxes and build more wealth, as well as a few other things that you can see in some of my videos. But for this video, I'm going to focus specifically on removing the taxes from a 401k, IRA, etc. This works for any retirement account, any pre-tax account. It also works for real estate, etc. However, I'm going to refer to this for the rest of the video as the 401k because most people have a 401k. So when we do a K1 conversion, the first thing I want to do is explain the concept. So when you start a K1 conversion, what you're doing is converting 401k money into non-qualified partnership capital. Your capital becomes the working capital that a private investment fund is going to use to buy real estate. After that fund buys the real estate, what they're going to do is lease it back for a predetermined amount. So again, 401k, distributing 100% of the money inside the 401k. That's just what I'm using in this example. And that money is now converted or repositioned into some type of private fund that is going to use your money as working capital to go out and buy real estate. Now, when it buys that real estate, what's going to happen here is they are going to purchase the real estate and then they're going to lease it back. Now, this is common in the corporate worlds. Corporations, for example, Hanna Pharmacy. I'm sure you can think of a local pharmacy with 3 letters in your area. What pharmacies like this are notorious for doing is building some type of retail center, so a pharmacy, and then they sell it to some investor. When they sell it to that investor, they immediately lease it back. This is called a sale leaseback. Same thing we're doing right here. We're buying someone's real estate, for example, Hanna Pharmacy, and immediately leasing it back in maybe a 3, 6, 10-year lease, and then which that lease is going to create predictable income for the investors, aka those doing the K1 conversion. Now, because the fund actually owns the real estate, they can depreciate that real estate and then pass that depreciation through to the investor via a K1 loss. They're not getting the depreciation, they're getting what's turned into a K1 loss. And that is ultimately what offsets 100% of the taxes due. So again, selling a property, so the fund purchases the property, they're using the working capital to purchase that property. The actual business, Hanna Pharmacy for this example, they sold the property, but they lease it back, which is what creates the income. Now, in effect, this does 3 things for the investor. So when you do this K1 conversion, you get 3 things. Number 1, a K1 loss that offsets 100% of the taxes due on that distribution. So you distributed $1 million, creates a $1 million taxable event. 100% of that is mitigated by the loss through the depreciation of the real estate. Number 2, you get predictable income from the lease payment from the corporation. So Hanna Pharmacy leases it back from this private placement investment fund, leases back the pharmacy. They're paying them rent every single month, and that is going to create predictable income for the investor. So you are essentially receiving the rent payments. And then number 3, it preserves the principal because the principal, your $1 million, was used to purchase this piece of real estate. And then at the end of the lease, when it's sold back, that is how the capital is returned, which typically these take about 3 to 6 years, sometimes 10 years. Okay, so let's walk through a hypothetical example of how this works here. So let's say you have $1 million that you invest into one of these private placement investment funds. You have a $1 million 401k and you want to do a K1 conversion on that. You want to eliminate 100% of the taxes, not only on the distribution, but also the majority of taxes on dividends payout moving forward. Let's just say that's what we're doing here. $1 million goes in, it's offset by a K1 loss, so no taxes due when you distribute that money into the private placement fund. And then we start collecting lease payments. So year 1, that lease payment that pays out, let's say it's a 10% dividend, which is what I'm seeing right now with these funds. That's going to be $100,000 that you're going to have to pay taxes on. In year one, with these structures, you do pay taxes on the dividend because the tax mitigation that came, let's see if I can do it right here, that came right here on the $1 million invested from the 401k. So this money will be taxed. Now, years 2, 3, 4, 5, and 6, the dividend that's paid out, there will be no taxes due on that dividend because it's offset by a loss. So this is offset by a loss, 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 and that's offset by a loss. And then at the end of year 6, when the lease ends, there's a contractual agreement that they're going to sell the building back. So the building is sold and the capital is returned. So 100% of your $1 million is returned back. So over 6 years, you would have received $600,000. You would have received $600,000 in dividends, which again, you only paid taxes on $100,000 of, and then you receive 100% of your capital back, which, where did it go? Which is a non-taxable event. Okay, so $1.6 million total is what you get. That's a hypothetical example. Obviously, it's going to be different for pretty much everyone, but what will remain the same is that the money that goes in year one that's distributed from your 401k, there will be no taxes due on that money because, again, we are converting qualified accounts, which qualified accounts are just ERISA plans, pre-tax dollars. When you hear me say qualified, think 401k, IRA, etc. That money is converted into non-qualified partnership capital. There's a GPLP structure to this, which now we're kind of getting into specifics. I just want you to understand the concept in this video. So then they take, again, your money and they're using it to buy real estate. And as a result, they pass through a loss to you that offsets it, plus lease payments of about 10% a year. That's, again, what I'm seeing right now. And obviously, nothing here is guaranteed. This is not financial advice. This is not tax advice. This is not legal advice. This is just my opinion. But this is what I'm seeing right now. So if you would like to learn a little bit more and you want to see, hey, what funds are actually doing this right now? What would this look like for my situation? This is what I do for a living. Would be happy to walk you through your numbers, give you that more information and show you, hey, here's kind of the before and after of maybe you're looking at doing a Roth conversion. This is much better than a Roth conversion. But you can find my information below if you want to reach out and get more information and see kind of, hey, what would this look like for me? Would love to chat with you. Take care. Have a good one. Bye.